Hello, everybody. Happy
Big day.
Tuesday. Thank you guys so much for joining us for another Stocks from Scratch. I'm Brian Feraldi. I've been investing in the stock market for 20 years.
My name is Brian Stoffel. I've been doing it for a little bit less than that.
And Mr. Stoffel, big day today for a number of reasons. First off,
Huge day.
we're talking about an extremely exciting company that a lot of people have been very interested in talking about. What stock is that?
That is Palantir. I still think that the vast majority of people don't understand what this company does.
Fair enough. Hopefully we can demystify today the stock today. We're going to be researching it from scratch. And we are also going to be doing so with our new version of Stock Simplifier. It is finally ready. So
I've been waiting to do this for some time because I use this tool all the time.
Yep, months and months of work to get here. So thank you guys so much for your patience. But we want to know from our viewers, is this a stock that you currently own? Let us know in the chat if we're talking to shareholders or prospective shareholders. We want to know who is here. Now, Brian, I do like to think about how easy or hard is this company to analyze. My best guess was about here. What'd you think? Roughly, right?
I think it's like between the orange and the red. So I think you're in that right area. Now I'm curious, Brian, do you own this stock?
I do not. I do remember covering it when it first came out, and I was turned off by the huge stock-based compensation, which taught me a lesson that I overvalued the stock-based compensation, which is still egregious, but has not presented this company for being a fabulous, fabulous investment.
I do own shares. And what really got me was, and we'll get into this, getting a better understanding for what they do, but also how they changed their sales process. That was a big part of it.
That is what we are going to cover. Now, if you've watched this before, you know that when we do these analysis, we use a tool that we built called Stock Simplifier. This is the product that we built to help us research stocks from scratch. So for those that don't know the history of that, so the mission of the product is to make stock research easy. When we built the original version of Stock Simplifier, we basically studied the best investors in the world, the people who made their process, not just their picks, kind of public. So all the famous investors that you can think of. And we boiled down the principles that all of them shared, and we put that into version 1 of the product. So version 1, which many of you have bought and are likely seen us use, was a course. It was a checklist. And it was later we added in these AI prompts that made the research so much easier. Now, what many people don't know is that everybody that bought Stock Simplifier, I sent them a calendar invite, and I talked to dozens of our users, and I said, hey, what do you like about it? And more importantly, what do you dislike about the current version, Stock Simplifier 1? So here were the common dislikes that I heard. So issue number 1 was people said too many tabs. You had to keep the course open, the checklist open, the prompts, the Google. And if you've ever seen us do this, you've seen us kind of going back and forth between a lot of tabs. Too many tabs. Yeah, too many tabs. Issue number 2 was the AI accuracy. Now, I would say that this has gotten better as the AI is improved, but even still today, we have to double check the numbers that we see when we use things like Gemini, because the numbers that they pull up aren't always 100% trustworthy.
Yeah.
Issue number 3, lack of nuance. So we kind of gave you red, yellow, green, but a lot of times we are like, well, this is kind of a reddish yellow or a yellowish green. Well, people wanted more choices. Issue number 4, probably the biggest, was every time you researched a new stock, you had to open up a new Google sheet. And
tabs upon tabs upon tabs.
That made tracking what you've previously done very difficult. And then finally, there was no discovery. So you had to know what stock you wanted to research ahead of time. We didn't help you kind of find one at all. So those are all of the issues that we have been working on fixing. And we have fixed them all with the product we're going to be using today, which is stocksimplifier.com. This has taken us months to build. So let's just go ahead and show off how it is. So this is the new Stock Simplifier, stocksimplifier.com. And we're going to start by entering a ticker, PLTR, Palantir. And it's going to go out. It's going to look up the company and just say, hey, is this the right company? So Palantir trades on the NASDAQ, $154 a share, market cap, US, industry and sector. Looks good. We'll continue. All right. So up here, first we have just a standard chart, right? So this is a company that has compounded 63% per year.
Not bad.
If you bought at the IPO, crushing the 15% you got from the S&P 500. $368 billion market cap. And Brian, we have the mission statement right up front.
I love that. I love that.
To build software that empowers organizations to effectively integrate their data, decisions, and operations. A little wordy, but okay. All right. So if you've seen us analyze businesses before, you know we like to get to the gist of something really fast. So that's what we've programmed this to do. So let's learn about the business. So Palantir builds software that helps massive organizations make sense of their data,
big customers,
and act on it. It has two product lines that do the heavy lifting. Gotham, which is built for defense and intelligence agencies, and Foundry, which is used by commercial enterprises, including manufacturing, healthcare, energy, banking, and more. AIP, which was launched in 2023, sits on top and turns enterprise data into AI-driven workflows. Now, here's what's interesting. The go-to market is unusual.
Yes, this is what I was talking about.
Instead of selling through partners, Palantir's engineers embed on-site with customers for days at a time and build a working AI workflow on the customer's own data, and then they convert it into a prototype and then into a paid product. Talk about custom building this software. Amazing.
Yeah, let's just pause on that. So I know the company more than just what we're reading right now, but it used to be so hard to send a sales representative out and say, Mr. Feroldi, I want you to go convince Johnson & Johnson that they need to use Palantir. And so you go knock on the door. And the thing is, that's a hard sell because it's a 5-year contract, say, to build something, and they don't understand what you're building. And so they had a lot of trouble selling things. Conversely, what they're doing now is they're saying, you call Johnson & Johnson up and you say, hey, do you want to send someone to our headquarters? I think they're located in Austin, but I'm not sure. Send someone to headquarters. We'll pay for their hotel. We'll pay for their food, everything for 5 days. Come on over and we'll build something for you. And guess what? It's free. It's free. We're going to build you a solution on your data for free. And it's just, this is a very crude example, but it is like a drug dealer. Like you're showing them what you can do for free. There's no reason not to take them up on this. You go back to your company, you show them this new tool, and you're like, oh, we need this. We absolutely need this.
They effectively start with the implementation.
Right.
The implementation, it's not buy it and then implement it. It's we develop the implement and you don't buy it until it's implemented and you love it. So, and they can do that because of who they're targeting. So massive businesses. They're not targeting small or medium-sized businesses. So U.S. defense and intelligence agencies are the main customers, governments, large commercial enterprises, and general big size. So their customers are enormous Fortune 100 / government style of businesses.
I like
really
this next slide that you have that shows it, because the big knock on Palantir when they came public was that they were completely reliant on the U.S. government for all of their revenue. But you can see there that green part is the government, but the blue, it's almost half of it is commercial businesses.
Yep. So again, we're in snapshot mode. So half their revenue is from the government, half is from commercial, 3/4 is from the US, 16% from the rest of the world, 10% from the UK. So commercial is growing faster, and AIP is pulling in large enterprises into Foundry deployment. So their AI product and their on-site development is really working to grow the commercial grow the commercial business. So their business model is just humming right now. All right, now we get into the business quality. Now you've seen us ask business quality questions, and there's 4 questions that we asked. Question number 1, how predictable is revenue? So we have a nice card here that says, hey, this is highly predictable. The AI says highly predictable, and it gives you 2 sentences here that says so. But if you want a little more details, you just click and the card flips and it gives you more details about why it came up with that. So the contract backlog doubled.
What?
Yeah, RPOs doubled last quarter, up 134%. 60% is sitting beyond 12 months. Net dollar retention is 150. So existing customers spent 50% more last quarter than they did the year before.
Just
up from
think about what that means there for a second,
it's
too.
Bananas numbers. Super high quality. And then decade-long tenure. The top 3 customers have been with Palantir for an average of 10 years. So the renewal rate is the default outcome, not a contested one. So is revenue predictable? Definitely predictable. Number 2, can it raise prices? So this is a Buffett question, right? Does the company have pricing power? So this gets a yellow sometimes. Pricing power is real on the government side, but thin on the commercial side because it's competing against Microsoft and Databricks. So Gotham defends its pricing. The expansion is what's driving net dollar retention, but commercial pricing is being contested from Microsoft's Fabric product, Databricks, and Snowflake. So it has much more competition on the commercial side than it does on the government side. Makes sense. Next, how recession-proof is this business? Highly recession-proof. Government spending is anchored in multi-year defense deals that run on political cycles. Yeah, makes total sense, right? You don't pull back on defense spending during bad times. So don't have to prove that one. And then finally, what is their competitive position? So a quick look at the moat. And this says dominant. Palantir is the default mission software platform for government and sending agencies with 46% operating margins. So it's the default in government. Anduril is a partner on its Titan program. Its operating margin is insane, 46%.
That's ridiculous.
It's just that the commercial business is where it is seeing competition.
So half is like more protected. The other half is exposed to the vagaries of capitalism.
Yep. So one page, you can kind of scroll through it quick. If you want a shallow dive, you can click if you want a medium dive. And on every page, we have these deep dives built in. This is like a 1,500 work deep dive into the business that goes into those segments far more detailed if you want them. So we designed it for shallow, medium, or deep, depending on what you want. And then at the bottom, you just rate it 1 out of 5. So what do people think? 1 out of 5, now that we know about Palantir's business, is this 5 out of 5? Crazy exciting, seems like an awesome business. 1 out of 5, pass, not interested in this company at all. What do people say?
All right, we'll wait for those to come in. Now, Brian, just so you know, a couple people are letting us know that we're getting temporary freezes. We apologize for that. We check our speed before we do this. So it's not on our end. We're doing this through a company, and it's the streaming is probably on their end that we're getting it frozen. I would say that by and large, the average is a 4 with a range from a 2 to a 5.
Wow. Okay. I will totally say 5. To me, this business is dominant, recession-proof, high margin, pricing power. I'll go 5, but I understand why you would go less than that, but I'm personally going to go 5. All right, next. Now we have to focus on the phase. Which phase of the business growth cycle is in? Now, this requires a little bit of explanation because we deleted a phase with the new stock simplifier. So now there are just 5 phases.
There used to be 6.
Yep. If you want more info on them, we put the info button right there, and there's a video that explains it. But essentially, there's the startup phase, the hypergrowth phase, the operating leverage phase, the capital return phase, and the decline phase. And
we got rid of that break even.
What phase you choose impacts the rest of the analysis. So this is really critical. We deleted a phase and made it just 5 for simplicity, but the big reason is we can really define these edges. And when we upgraded to going to 5 phases, the accuracy on the AI guessing at the phase went to like 99.9%. So the AI says this is a phase 3 operating leverage company. Now, why? It's the revenue is growing very quickly. It's profitable and it's growing, and it's returning cash through buybacks only. So this is some nuance we have to get into. So Stoffel, if the company is buying back stock, why isn't it in the capital return phase?
Because here's the thing. A lot of companies will buy back stock in order to offset some of their egregious stock-based compensation policies, which is, Mr. Froley, why you stayed away from the company in the first place.
Yep.
It does not mean that they are shareholder friendly in the traditional sense. They're just trying to be less shareholder antagonistic. So we don't think that is enough to qualify as stage 4.
So we've programmed the AI. You only qualify for capital returns if you're buying back stock and your share count is declining. If you're buying back stock and your share count is still growing, you're in the operating leverage phase, and you don't graduate until you either pay a dividend or start reducing the share count. That's why it's in phase 3. Now, what's cool is if you flip the card over, you can actually see the company's history over time. So it looks like it transitioned to profitable in 2021. And then we give you some key numbers. So revenue growth has been outstanding. The profit metric, which in this case is operating cash flow, this changes from company to company. 2.7 billion, outstanding. Buybacks are just 57 million, which is 4% of operating cash flow. So again, are they returning capital? Yeah. Is it meaningful enough to reduce the share count? No. Hence why it's in phase 3. Now, again, if you want to go deep, you can click this button here, but we just give you a picture and say, choose your phase.
Now, Brian, what's that little icon there?
There's a little robot up there. That's what the AI suggests, but the user is in ultimate control of all of this. So I can choose a different one if I want, but I'm going to agree here and say it's definitely in the operating leverage phase. Next.
Let me just say, this is the screen that I spend hours upon every day for different companies.
Yep. So we have now broken out Moat into 2 different sections. First is, what is the current state of the moat? And just as important, what is the direction of the moat? Now at the top here, AI gives you its suggestion. So AI says Palantir has a narrow moat. It's durable on the government side, but it's still under construction on the commercial side where Microsoft contests. So government switching costs are enormous. Commercial moat is not yet fully built out because of Microsoft and Databricks, and it's operating network forming with 1,300 AIP boot camps trained on a labor base, not yet at hyperscale reach. So it gave it a 3 out of 5. On the direction, the moat is widening. Why? Because of operating margin is expanding so quickly. Net dollar retention is huge, up to 150, and its backlog doubled. Now, we give you some visual clues based on the 5 styles of moats, which ones are currently active.
This is my favorite part.
If it is active, it'll show you how strong that moat is, the direction, and it'll give you more information if you click. So switching costs, classification, accreditation, the embedded engineering, and the tenure of its long-term customers.
So to be clear, what that's saying is switching costs is both wide and it's saying widening.
Yep. So switching costs is its dominant moat source. Next question, though, is does scale help? Is there a network effect? This says somewhat, with Microsoft being the biggest threat there. Is the company's brand name or IP useful? This says sort of.
I think of the yellow as narrow moat.
Yeah, narrow moat.
The red
exactly.
is no moat. The yellow is narrow. The green is wide.
And that makes sense. Palantir, I would say, is well known amongst its customers, and that brand name is getting stronger. So it's not like the strongest yet, but it's definitely developing. And there's some more information as to why. And then finally, can incumbents copy this? AKA, is there counter positioning? And it says somewhat. Again, if you want to go deeper on the moat, lots of information here on the moat for you, but let's just give some opinions here. So
Well,
this
what do
time
you
I
want
want
people to type in?
2 numbers from you.
Okay.
The first number is the size, 1 to 5. What do you think is the current size of the company's moat? Second number to type in is the direction, 1 to 5. What direction is the company's moat going in? And again, AI says this is a narrow moat, 3 out of 5. That is 5 out of 5 widening.
Now, and the great thing about this is like you put the numbers in, but if you do the work, then you like, if it was the government side, I would give it like a 5 and a 3 or a 5 and a 4. If it's the commercial side, I would give it like a 3 and a 5. I would say that on average, we're getting 3s and 4s for the side.
Okay.
And we're getting 4s and 5s for the direction.
I'm going to go with 4 for size. I totally get, I would say, again, government is super wide. Commercial is less so, but those are 50-50. So I'll just blend them together and say 4. But out of direction, I love the embedding the engineer on site and building a custom product. Like that is really compelling. And it's obvious from the numbers that is working. Like that is definitely working. As a side note here, if something catches your eye, like let's say this catches your eye, okay, 3 customers are at 10-year tenure. We have a little button right here. You could actually take notes on the company as you go. So we gave the option to kind of like take notes and build notes for yourself as you go along. Okay, next, growth analysis. So again, the AI gives us an estimate out of 5. This says growth is 5 out of 5. Very high growth potential.
To be clear, potential. Not what
future growth.
We'll consider past growth, but the real question here is about moving forward.
Revenue grew 30% annually and then accelerated to 85% with both segments and both end markets firing at the same time. So revenue grew very quickly with 85% in Q1. Both segments are firing. Government grew 76%. Commercial grew 95%. Commercial up 133%. Wow. Free cash flow is growing even faster. Free cash flow is growing 60% as the company accelerates and right sizes into the business model. So here we have revenue growth. So 32% over the last 10 years. Earnings have grown from negative to highly profitable. And then we ask some high-level questions about the growth. So is the industry the company is in, enterprise-level AI, is the industry a tailwind or a headwind? So this says definitely a tailwind. As more customers adopt AI, that is a tailwind for this business, no doubt. And then the next question is, can new offerings drive growth? If you're familiar with the term optionality, can the company create new products or new services that open up new revenue opportunities? This says AIP is a big one. A defense hardware, the Titan partnership with Anduril shows Palantir attaching Gotham AIP to hardware-led defense systems without taking on hardware capital intensity. Did you know that?
I did. I know that they embed that technology inside of physical systems, like say a combat drone or something like that.
That's cool because hardware plus software equals way better durable growth, in my opinion, than just software alone. Okay, again, you can go way deeper on the growth potential if you want, but I have a feeling I know how people are going to vote on this one. So 1 to 5. What do you think of Palantir's long-term growth potential for the business?
I'll be curious, Mr. Feroldi, what would you say here? I have a feeling that you're going to agree with what Francine wrote, but what would you say?
I don't know how you not say it's exactly what everyone's saying. 5 out of 5. Like the growth potential here, not only historically has been outstanding, but they've done it while they were public. In fact, growth has accelerated since they came public. And it's very clear that their early on bets from a couple of years ago are super paying off right now. And this is a highly scalable software business. So to me, it's 5 out of 5.
We got everybody saying that. Almost everyone gave it a 5.
Okay.
To me, the big thing is this. To me, the big thing is you're talking about huge customers. They don't go after small companies, just huge customers. And changing things at a big company internally is like trying to get the Titanic to do a 180.
Sure is.
You need someone to come in and do that. And that's the key to me.
Yep, sure is. Okay, next, management. So we debated, just general question, what makes for a good management team, right? I have heard so many different things. Well, it's a great culture is a good management team. They exceed expectations. They cast a good mission, or they're good communicators.
Very subjective.
To me, good management is a management team that turns a story into numbers. That's good management. They cast a shadow. Here's what we want to do. And then they do it. They execute. And that to me is good management. Can they execute? But we have several things that boil into that. And that's what the AI is telling you. How good of an executor are they? Plus, there's some more details for you to make a decision. So, okay. All three co-founders still run the company 23 years in, with operating margins scaling from -27 to +46, and 8 out of 8 earnings per share beats in the last 8 quarters. The founding team is still intact. Karp, Thiel, and Cohen have all been in their roles since 2003. Very rare at this scale. In fact, I can't name another company that has 3 of its co-founders all still involved with the business 23 years later. Margin transformation. So they have successfully scaled the business from negative margins to positive margins, and cash flow has grown to a huge number. And then perfect track record with exceeding expectations, sometimes largely so. Now we also show you who the founder is. So in this case, Thiel gets he's an active founder, and he gets super voting stock. And then who is the CEO? Alex Karp, 23 years, who has super, again, this is a controlled company, right? Now we show you, hey, do employees like working here? So reviews from employees are actually mixed. So they say pay, mission, and career will work well, but bad work-life balance. Very hard work-life balance, but they give it a positive outlook.
So that's pulled from Glassdoor, right?
Correct. Review sites like Glassdoor. Yeah. Next, do they beat expectations? 8 out of 8. They have exceeded expectations by large numbers in 8 out of 8 quarters. So great execution. Are they shareholder friendly? So AI said somewhat. So it's giving them a lot of things for skin in the game and the voting power. But the 32% dilution is working against them.
That's a big knock against.
And they're actively selling stock. So, but it's hard to complain given what they've done for shareholders, right? Even though it's not shareholder friendly, shareholders have certainly won. And then finally, this is a metric that changes depending on what phase the company is in. So for a company that's in phase 3 of the operating leverage phase, we want to measure free cash flow margins. So we're taking a look at margins. Is the company successfully scaling and turning that into cash? And from that sense, they're doing great job. All right, I want to hear people vote 1 out of 5. What do you guys think?
Let's be clear too. Yep. We know that this founding team can be quite controversial as well.
Extremely controversial.
Our AI does not take that into consideration, but that's the beauty of you being able to give the final call on this. Our little robot just makes a suggestion.
Well, again, we are judging this management team from the lens of investors. That is the lens that we're looking through. Is this team good for investors, right? There's all kinds of ramifications that you can think beyond that. The lens that we look through, this is an investing product, is what should you trust this management team from the investment lens? What are people saying?
4 is our most common response.
I would say that is pretty fair.
Yeah. There's a lot of dilution.
It depends. Yeah, the dilution is very high, but the execution has been outstanding. So I'll actually go 5. To me, execution trumps almost everything. But I understand if you would go less than this, but I'm going to go 5 out of 5.
Yep.
Personally. Okay. Next section, risk. Now,
here's a big one.
The risk that we're talking about is execution risk. That's what we care about. what are the things that what is the odds that the company can't execute against its roadmap? So this does not include valuation. Valuation's next. We're only talking about business execution risk. Okay. So this says moderate. Business is exceptionally, balance sheet has 0 debt and 2.1 billion in free cash flow, but government concentration, politically contested contracts, and a dual class voting keep the rating above low. Okay. So excellent balance sheet. Yep. But 54% of the revenue is from governments, and the founders still control basically the business. All right. So then we get into our 4 subcategories of risk. Risk number 1, revenue diversification. This is customer concentration. So 3 customers are 16% of revenue, but no single customer is 10% or more. That is a big change from when this company came public.
Yep.
So diversified revenue with more than 1,000 customers. Impressive. Next, is disruption a threat? And this says some risk. So Microsoft
on the commercial side.
And yep. And Fabric could compress founders' commercial value with deeper distribution, and the LLM commoditization could make it something for them to make it harder. So I view them as almost like the disruptor. So I don't know how seriously I'm going to take that risk, but it's at least worth knowing that competition is a risk. Next one. How much is outside of their control? So how much are they depending on outside forces? So government revenue is 54% of total. The US government alone is 41%, exposing Palantir to federal budget cycles, political contested flagship contracts, and AI regulation. AI regulation. Yeah. Oh yeah, this company is in Colorado, and I did see that some states were trying to they're moving their headquarters to Florida. Oh, I guess they just moved to Florida.
Well, there you go.
To get away from Colorado. Wow. And then the final one is, what is the financial risk here? So basically 0, quote unquote, financial risk. No debt, tons of cash.
Tons of free cash flow.
Yep, tons of free cash flow. Financially, extremely low risk. All right. What do you guys think? 1 to 5. Palantir business risk. Don't think about the valuation yet. That comes next. But just from a business operating risk perspective, is this a high risk company, moderate, or very low risk company? I'm actually going to take that. Where was that?
Make a note of that.
Yeah. And moving to Florida is very interesting. I'm going to put that in the notes section. All right, what are people saying?
We've got a lot of 3s and 4s. I would actually go with 4.
Yeah, I think so too.
The political risk was something I was thinking about, but these contracts are super long term.
Yeah, very long term. And look, I like to look back at the past execution. What has this company's past execution been?
Right.
Sensational. Sensational. So that to me lowers the risk when I see a track record of execution already in place. There's definitely some geopolitical stuff that's worth thinking about, but given the moat, given the past execution, and given the management, I'm going to go with 4 out of 5 low.
Yep.
Okay, next. All right. Valuation. So valuation changes depending on what phase of the business growth cycle the company is in. Now, we tried to make this as simple as possible, and making valuation simple is extraordinarily hard. So we make it simple by showing you what metric is most likely to be the one to focus on given the stage. Then we show you a second metric and show you how to weigh that. And then we measure that using this very simple scale: red, yellow, green. Red expensive, green is on the cheaper side.
It is important to look at the absolute numbers here.
Yes.
Because, Brian, if we look at this, I look at this and I'm like, green, great, Palantir's cheap. But then I'm like, well, what does it need to be green? Because our AI is trying to weigh where the company's been in the past. And if what I see looks correct, if it's under 200,
yeah, that's been the average.
200 times trailing earnings, it considers it green. So you have to weigh these different things.
So that's why right up here we compare the company's ratio to the S&P 500. So while it does look moderate compared to its recent history. It's 6 times as expensive as the S&P 500. So we give you one ratio here. That's the primary one that we think is the most useful. But down below, we give you a bunch more. So you can look at price to free cash flow, price to operating cash flow, shareholder yield, if the company is buying back stock or returning capital, price to book, price to sales, and price to sales, it's what? 73. So on a price to sales basis, I mean, no doubt crazy expensive, although not as bananas as it was. And then we also have price to gross profit, a similar number there. Now, for a company like this, if you know about reverse discounted cash flow analysis, I would recommend doing so. And if you are going to read one pro analysis, like the full thing, please make it the valuation one, because the valuation context that it gives you in the deep dive, the pro analysis, is extremely good.
Yeah,
I think it takes
great.
out cyclicality. It gives you context. Yeah. So Palantir trades at one of the most extreme value multiples in the public software universe, right?
That's a great thing to start with.
Historic context about how this number has swung. So the deep analysis is very good, but we can actually do a reverse discounted cash flow analysis on this company right inside here. So based on the current share price, 153, based on $2.7 billion in trailing 12-month free cash flow, and based on 2.4 billion shares outstanding, we didn't even say this. Every number you see on the screen comes from Fiscal. It comes from Fiscal. So we have partnered with Fiscal. We actually buy data directly from Fiscal. So that's how when we show you a number, we can be sure that it's correct, because Fiscal is a institutional grade database. So we're not just pulling this randomly from AI. We are buying every number you see from Fiscal. And we actually put a button right here. If you want to go to Fiscal and get deep into the financial statements of it, you can do that easily if you want to. But those is where the numbers are coming from. Okay.
So let me just say, we've got a reverse DCF. Importantly, for folks that watch my YouTube channel, this is not an optimized reverse DCF, but we can build that in later. This is just using trailing 12 months. I would pull the terminal growth rate up for a company like Palantir personally.
To what?
Maybe between 3 and 4. It doesn't change very much what it spits out.
Because of their pricing power?
Yes, because of their pricing power and just this long tail of growth.
Okay, 10% discount rate is a decent enough starting point. So that means to justify today's price, Palantir has to grow its free cash flow 33% per year for the next 10 years to earn a 10% return from today's price. So then you ask, do you think this company can grow faster than 33%? If so, it's undervalued, or less than 33%, and then it would be overvalued. Now, we give you a nice little table here to show you what different assumptions would mean, but here's the visual down here. So this gray line here, this is what 33% growth indicates. So right now, they would have to get free cash flow to $49 billion in 10 years for today's price to make sense. And we give you a little thing here to say how fast you actually think they're going to grow. Well, wow, the scale doesn't even go that high, but you can see how
there's high expectations baked in.
Very high expectations. 30% growth, 33% growth is extremely high expected growth. Now I'm going to go to Fiscal, and if we taught people to do, if you go to the overview page, you can actually see how much they've grown. So revenue has grown 33%, although we know that just exploded. Over the long term, which is like 5 years, earnings are expected to grow 46%.
That's faster than 33.
It is. Revenue is expected to grow 58%. So revenue is going to grow almost 60%. Earnings are going to grow 46%. So boy, that was a lot of context. Multiples, crazy high, right? But not as crazy high as they have been historically. The DCF, reverse DCF, also very high, but the expectations and the execution are also very high. So I can't wait to see how people vote on this one.
Yeah, I know what I would give it.
What do you think of Palantir's valuation today? One would be, this is insanely expensive, way overvalued. 5 would be, it's very attractive today, even at this very high valuation. What are we getting here?
So far we've got a 4 and a 2, another 4, a couple more 2s. When I do this, Brian, to be honest, I give it a 3 because if you go to Palantir real quick on fiscal, I know we're not, but if you go to the revenue growth, if you go to financials, or you can go to estimates or look at how fast it is expected to grow. I mean, first of all, you see the estimates keep being revised upwards and upwards and upwards and upwards and upwards.
Yep.
But if you go to the income statement, Brian, and you click on the revenue growth rate, and then you pull it forward. So, I mean, look at those numbers. Like, it's expected to grow 73%. Like, that's crazy.
What makes the market foam at the mouth with excitement? It is accelerating revenue growth, ARG. And this company was growing 16% in 2023. And that the growth rate is going up and up and just expected to go up. This is absolutely why the market is in love with this company. The growth and the growth rate acceleration has been stunning.
I mean, it's incredible. It's incredible.
It is incredible. All right. So what do we think here? What
3 was by far the largest one.
3? Okay. So
3.
So there you go. Yeah. So in absolute terms, this company is expensive. In relative terms, it's moderate. And if you believe the growth is going to continue to accelerate based on the execution, maybe, just maybe, it's not insane. That is a surprising outcome.
And the hard part is we're talking about 10 years.
Right.
Look, like every time Anthropic dropped a new co-work solution, the future changed. So it's hard.
Yep. All right. So at the end of that process, you get a composite score, and we take the business score, which we did a 5. The phase is not counted. The moat, the current moat, the moat direction, the growth, the management, and the risk, and we compile them together. We do not include valuation in the composite score. That's something that's separate. But from a business perspective, it's almost like what's not to like.
Right.
But then we say the valuation is a separate thing because the valuation changes drastically, and whether or not a company is a buy or not is a factor of business quality times valuation. So that's why they're 2 separate things. And then you just say, okay, what list do you want it on? My pass list, which definitely put stocks on your pass list if you don't want to research them again. My watch list or my buy list. So personally, I'll put this on my watch list because I think the valuation is a little higher than that. Actually, I'll put it on my buy list. Sure.
There you go.
We'll do that. So then we just click save. So here's our dashboard. So all of the stocks that I have researched in the past are now on here, and they're trackable. And I can see when I researched it, the last time I researched it was the current price. I can see the phase that it's in.
Can you click on that so we can see your prior ones real quick? Can you just show us how it should? All right.
If I want to access my notes, I can see my notes. If I want to see the analysis that I did, including the price that was at when I did, as well as some details about that. And see how there's like a plus next to these numbers? So every time you analyze a company completely, it will save your analysis. So you can actually track how your thesis is changing over time as you get to know the company better and better.
And you can see, looking at yours, that your thoughts on the risk have changed over time.
The risk has gotten, that's actually the valuation. But
but your risk has too. It's gone from 2 to a 3 to a 4.
Yep. Don't read too much into my scores. I was just putting data in.
You were practicing, I know.
Yeah. But I can, if I click on any stock, I can see my history with that company. If I want to just see, okay, these are the stocks on my buy list. This is my watch list. This is my pass list, etc. If I want to make a new list, I can make a new list here to put some stocks on, and I can actually filter my list. So what if I say, show me all the companies that are in phase 4 that have a wide moat, that are growing, medium or high, and have a low risk profile with an attractive valuation. So I can sort through all the stocks that I have personally scored. And remember, these are the numbers that I put in. They're not the AI. I put them in. So I can actually trust them because I was the one that was building out my database as we went. So you can sort through and track the companies that you've already put on your list way easier. And if you want to start again, you just click simplify a new stock. And that's how we would start again. So that's the new stock simplifier. That's stocksimplifier.com. We hope that you agree that these are some massive upgrades compared to what the old system was. And it's taken us months and months of development to get to this point. One other thing I want to show you. One of the most difficult things, or the biggest piece of feedback, was like when they get to this page, people get stuck on like, hey, what stock do I choose? So we built in a little database right here where we're growing it out as we're adding stocks to this. And this is all the stocks that are in our universe. And what's really cool about this is we are building in tools so that you can sort the stocks that are in our universe. So this is the only tool that I'm aware of where you can say, show me all the companies that are in phase 3 of the business growth cycle. So give me phase 3 and phase 4 of tech companies. And you can do it by industries there, but this is the AI guess at what phase the company is in. So you can actually match searching for companies based on what type of investor you are. So it's not just sort by growth rate or gross margin or return on invested capital. We're going to be able to do far deeper analysis and far deeper browsing. That's going to make stock research and discovery way easier. So that is stocksimplifier.com. We hope that you guys agree that it's a massive upgrade when compared to the old version. Now, one thing we do want to let you know about stocksimplifier.com is that it is built on Fiscal.ai's database. So that gives us data on about 10,000 global companies. So between that and like regulatory filings, we have all the data we need to build out an incredible database in here that will help you to analyze almost any stock that's publicly traded. However, one of the reasons we've delayed this release so long is because we are currently compute constrained. So analyzing one stock takes us about 40 minutes up front, and then it takes us another 40 minutes every time that company reports earnings or changes CEOs or makes an acquisition. So we're not data constrained. We've been compute constrained historically. So as a result, we've had to be very tactical with how we add stocks to our database. So right now we have the NASDAQ 100 and the S&P 500, plus a whole bunch of very popular stocks beyond that. So all the stocks that you can think of off the top of your head are already in there. NVIDIA, Google, Amazon, Tesla, Eli Lilly, all these stocks are in there. We actually did some math. It's about 84% of the total market cap of the US is in Stock Simplifier. But we don't have every stock in there yet. So what we're doing is every time one of our users searches for a stock, if it's not available, we actually get a request in our system, and that stock then goes to the top of an internal list that we use to add it to the database. So we're going to add stocks as our users tell us, hey, this stock interests me. And this is also a completely solvable problem. We think we're just like a few weeks away from completely solving this. The AI compute thing is becoming non-issue, but I did want to be upfront about that. So as I was doing one-on-one interviews with people, I was basically like, hey, what do you think this should cost? And every time I did a one-on-one interview, people were like, well, you guys now have developer costs, AI costs, fiscal costs, hosting costs. So most people said that they thought that we should charge between $30 a month and $99 a month for the new stock simplifier.
I'll just put out there, if you're wondering about that, to me, this has taken what is a 3-hour process and made it into, I mean, we just did Palantir in half an hour. It's not the end. It's not like that's it for my research on Palantir, but it is shrunk that window considerably.
Dramatically speeds up the time. So that's about $360 per year to about $1,200 per year. That's what people told us that's what we should charge for it. So that's a pretty wide range. So we're actually launching with 2 different versions. So version 1 or option 1 is called standard. So it allows you to analyze 20 stocks per month. It shows you everything that I just showed you. You get the multiple analysis. The AI is there to assist you. You get the watch lists, and it's all powered by Fiscal. And it comes with the stock discovery. But we have a more advanced one that we call Pro. Stock Simplifier Pro has unlimited analysis. You also get all of those deep dive analyses that were on the pages. You get access to the reverse discounted cash flow calculator. You get access to custom watch lists, and you can export your data as a CSV file if you like to work with it in like Google Sheets or Excel or something like that. Now for pricing, we've priced standard at $16.60 per month. So that's billed at $199 per year. I'm really happy that number is basically almost half of what people told us was the low end of what they were willing to pay for. So we think that is an extremely affordable price if you want to get started with Stock Simplifier. So $16.60 a month or $199, priced at $199 per year. Pro is $33 per month, or priced at $399 per year. And you get the extra analysis, the deep dives, the reverse DCF. I think it's totally worth it, but we did want to offer people 2 options if they wanted to get started with it. Now, because this is the essentially launch date, the public launch of Stock Simplifier, we have an extra special deal for people that are watching this. So you'll be able to get Pro for just $24.91 per month. We're basically knocking $100 off the annual price to be $299 per year. Stoffel, if you could be so kind as to share that in the chat so people that are interested in checking it out can do so. So if you use the link that Stoffel is sharing in the chat, it will take you to a custom checkout page where you can get started for just $25 per month on the Pro plan. If you want to go with the standard plan, you absolutely can. But the Pro plan is what we are offering a special deal on today. Now, in addition to getting Stock Simplifier Pro, everybody who buys today will get invited to a bonus webinar with Stoffel and I for tomorrow. So tomorrow, Stoffel is going to be taking his top stock pick for June of 2026 through Stock Simplifier. He's going to tell you why he likes it. He's going to analyze the business. He's going to tell you how much of the stock he owns and how he's going to track it moving forward. Everyone that buys Stock Simplifier, either version, will get access to that webinar and the replay. But that webinar,
and to be clear, they'll
tomorrow.
Get an email with a link to it.
Absolutely. In addition, everybody that is live with us right now, if you buy Stock Simplifier right now, we will also throw in Valuation Explained Simply, our premium course that teaches you how to value businesses. This is a course that costs you $299 on our website. We will throw this in for free with the purchase of either plan today. So as long as you join Stock Simplifier before the end of this webinar, we will give you this course plus tomorrow's webinar included with your purchase. So that's the launch deal. $25 per month, $100 off the Pro plan. If you buy either plan, you get access to Valuation Explained Simply, plus the special webinar tomorrow, where Stoffel is going to talk about his top stock for June of 2026. Now, we have gotten some questions that we want to just tackle, but we're happy to answer any questions that you have in the meantime. So what happens to the first version of Stock Simplifier? That's not going anywhere. Everything is still there. And if you bought that, you still 100% have access to the original version of Stock Simplifier. Question 2 is, well, what if I do this and I just determine I don't like it? We have a 30-day money-back guarantee on Stock Simplifier. So if you buy it, you have 30 days to kick the tires and tell us if you don't like it. If you don't like it, just let us know and we will give you a full refund. And then question number 3, well, what if we raise prices down the road? So if you buy Stock Simplifier today, the price that you pay, that special price of $299 per year, that will be locked in for life. So that will be the rate that you pay as long as you are a customer. So we hope that you find that deal to be compelling. We have put months upon months upon, I can't even tell you how many hours of my life have been built into StockSimplifier.com. My entire goal was to get Stoffel to make the product so good that Stoffel changed his behavior with it. And I think I accomplished my mission there.
All right. So a couple things here. So yep. I want to make clear that for those people who are members of our kind of even higher tier products like Stock Investing Mentor or Long-Term Mindset Community, this is part of it. If you are in Stock Investing Mentor, you already have Stock Simplifier. You have access to it. So nothing changes for you.
If you're in our premium community or if you're in Stoffel's Stock Investing Mentor, you already have access to it. You don't need to worry about it. For people that purchase Stock Simplifier 1.0, the very first version of it, we did a special deal with them a month and a half ago where they could have upgraded to the new version. If that's you and you didn't get to take advantage of that, just email me, Brian@longtermmindset.co, and I'll take it on a case-by-case basis. But the people that we offered the ability for people that are on 1.0 to upgrade to this about 6 weeks ago, and they've been beta testers. So we've been taking all their feedback in to show what we have.
A couple of other questions here. We have Kagiri asking, right now, you said the NASDAQ 100, the S&P 500, but our goal is to get it as large as possible.
Our goal is if it's in Fiscal's database, it will be in our database. So right now it is US only. That is a completely solvable issue. And we are going to rapidly add more stocks to it as we get more compute time and we get that solved. So right now it's US only. But if you buy today, we will gradually add more and more stocks based on search volume. And eventually this won't be an issue at all. We'll have every stock that we have access to through Fiscal. So that includes US stocks, Canadian stocks, European stocks, Australian stocks, Indian stocks, Japanese stocks. Like we want to add, if it's a stock, we want to be able to analyze it with Stock Simplifier. So Tim, that is currently that is something that we are building out access to rapidly.
Yep. Tim, if you bought it, send an email again or you can even reach out to Ken, and you know who that is, and we can make sure you get a refund for that if you paid for version 2.0, because that's included in Stock Investing Mentor. Here's a question. If people are in our higher tier communities, which version do they get?
Pro.
Nice. Couple people are saying the checkout page is frozen. I'm going to hope that's because a lot of people are going there and signing up. But if that happened, that link that we sent you will continue to work, correct?
Yes.
Awesome.
I just clicked it and it worked just fine.
All right, good. Yeah. I'm looking through to see if there's any other. Oh, here we go. Bill was asking what happens on the renewal date. Now, correct me if I'm wrong, but on the renewal date, you get charged again, but importantly, you get charged at this price. We don't move the price up.
Correct. The discount that we're offering today as part of the launch is fixed. So that is not, it doesn't go back to a higher price or full price. That it will be a fixed flat fee. That's why we wanted to launch with a really compelling offer. And as a reminder, if you do it today, either plan, you will join us for a webinar tomorrow where Stoffel's going to reveal his top stock and take it through Stock Simplifier. We think that's cool because if you have questions about how to use it, we can kind of show you tips and tricks about how to use it. We are very open to suggestions that people have about how to make it better. We have a growing list of, actually, I can even show you it. Well, I don't have it open.
Well, I'll tell you what. So for as many people as might be curious to come and join us tomorrow, I just want to mention that you'll find out about a stock that's now just shy of 10% of my real life portfolio, and I added to it yesterday. So that's what that will be about.
Okay, actually, let me show you this. Okay, I can do it now. Is it? There we go. Okay. So in Stock Simplifier at the bottom here, we have a feature request button, and if you want to, if you're like, hey, I have a great idea for how you can make this better, you can just click this button here and tell us exactly what feature that you want. And we keep track of these. And if you scroll through the features that you see other people do, and if you're like, hey, that sounds great, you can upvote it. So we are going to prioritize new features based on what people tell us they want. So we built in the ability to not only request new features, but upvote those that you see. And that's going to be our to-do list for adding new features.
I think we hit most of the questions. I mean, I'm excited to see what stock we're going to do next week when we use this tool and rate something else from scratch.
Yep, absolutely. Yeah, moving forward, I mean, we plan on doing lots of stocks from scratch, right? Every Tuesday, we pretty much come live. And we're going to be using Stock Simplifier moving forward. So we hope that you guys check it out. Again, it's 30-day money back guarantee if you're not interested, but people that have been using it so far really like it. It's a wonderful, wonderful companion. Here's what the real value is to me, and I think that you agree, Stoffel. The real value of this is getting to know as quickly as possible.
Mm-hmm.
If you have an idea and you're just like, hey, if somebody mentions a stock to you or they say something about, hey, this kind of thing, going through SEC filings or researching a stock the correct way, doing fundamental analysis, it can take a long time. So we built the workflow. Once you get used to the workflow, you can research a stock in minutes, and you can get to the crux of the issue, or you can discover something about the way that a super investor would learn about that business very, very quickly. So we designed it to surface all of the key information without overwhelming you with data. So you can almost say to me, any stock that's in the database, and I could go through the Stock Simplifier in a matter of like 3 minutes and tell you, for me, I'm interested or hell no. Very, very fast.
And what I'll say too, first, Sergey, yes, you will be getting an email with an invite to the webinar tomorrow. It will be at the same time, 12 Eastern. So just keep your eye on your inbox for that. The other thing I want to say, Brian, is this. You were saying, you can go through this really quickly. My fear has always been that this would basically outsource my thinking to AI. And I don't want to do that, because I do think that the human element to investing is, first of all, interesting. Second of all, it's where the edge is. My belief has changed. The way that I think of this now, Mr. Froldy, is I think that I have a junior analyst, and I can go and say, find out everything you can about this company, and then find the 5 most salient things that I need to find out more about. And before, I would have to pay that person $150,000 a year to go do all that work for me. And now I just use Stock Simplifier to do it.
Yep. Love that. Thank you for the wonderful comments that I've heard. Were you able to share that on Twitter by chance?
I did go and share it. It is in the comment section on Twitter of this video.
Yeah, we did get a question about if you join, how do you get the link to the webinar tomorrow? So we will email that to everybody that has a tag in our system for joined, and I'll make sure that works. We'll also send out the replay that comes out. Oh, one other thing that I want to point out about the design of it. So we've been asked, hey, can I just like see what AI thinks of all these stocks? We intentionally say no. We intentionally make you go through and you are picking the numbers. The reason is, whenever I read somebody else's analysis, even if it's like a great write-up, it's borrowed conviction. If I read somebody else recommend a stock and I read through it, I'm just reading through what they think, and it's borrowed conviction. So if you buy that stock and then it falls, you have to go back to that person for, well, what do I do now? Like, how do I think about this? The reason that we force you to choose, you are the one that's in control, is because when you're making the choices, when you're reviewing back at what you said, that is what you put in based on your thoughts about the company. That's how you build real conviction. It's based on you knowing the information. So we don't want to just give you what AI thinks, because that's borrowed conviction from a different source. We want AI to make it easy for you to get the information you need so that you can make an informed decision, so that when you are actually investing in these companies, when it drops, and it will, that you know and can reference, why did I buy this? What was the reason? So it's like, it's almost like a journal in AI form that helps you to manage your portfolio.
Yep.
Yeah,
absolutely.
Cool. Well, thank you guys so much for joining us today. We will absolutely be back next week with a stock. I personally can't wait to get SpaceX into Stock Simplifier. Believe it or not, we can get 90% of it there. The only thing we can't do is valuation, because
there is none.
we don't have, it's not publicly traded yet. But you can bet as soon as SpaceX goes public, we will get it into Stock Simplifier.
Same with Anthropic and OpenAI.
OpenAI, yeah, those should be some really fun research sessions later on this year. Well, thank you guys so much for spending some time with us. We'll give people 10 more seconds to buy, and then I'll unlock the valuation explained simply for everybody. Thank you guys so much for spending some time with us, and we will see you next week.
Bye, everyone.